concerns around Chinese economy that are also weighing heavily, not just on the Indian market, but also on global markets all across the world. A series of economic data that has come out from China has exposed the stuttering post-pandemic recovery for the second largest economy of the world. Now, China's economic activity data in July is dampening sentiments for everybody, from retail sales to industrial output to investments. All have failed to match expectations, fueling concerns of deeper, long-lasting slowdown in the growth. Add to it are the worries of deflation, a prolonged lowering in the prices, fueling concerns of further economic slowdown in China. China could be struggling to meet its growth expectations, or target rather, of 5% for the year. Now, Barclays has also cut its forecast for China's 2023 growth in the GDP to 4.5%, citing a faster than expected deterioration in the housing market. Investors so far are unimpressed with the moves of policymakers, and without more fiscal stimulus, recovery seems far-fetched. Karan Mehrishi is also joining us on the broadcast, but before we go to Karan, I want to first quickly get a lowdown of what's happening from my colleague Krishna here. Krishna, it's not just a double whammy. If there's a word called like triple whammy, that is a
multiple
problem.
whammies.
Multiple whammies. I think that would be more appropriate for China, and it's not even beneficial for the world anymore. It's not beneficial for anybody. You know, there was a time when we used to discuss how China's hurting economy could be could be beneficial to India in one way or the other. But all in all, in toto, things don't look good in China at this point at all.
Well, very not the best of times. And the thing is that they say, many economists, Shweta, turn around and say that what were you expecting? Because this was coming. Because those peak double-digit growth rates that China witnessed in the 90s and the early 2000s even. They were going to be a thing of the past. We are in 2023 after all. And especially what they did during the COVID pandemic. They were the first to get affected, and they were the last to
recover.
To remove their restrictions of a very draconian zero COVID policy that just completely shut off the economic activity altogether completely. So in that sense, the hope was that when they reopen, that they will roar back like tigers and lions. And what has essentially happened is that it is the data that's coming out is telling us that that is the opposite of what has happened. Unemployment rate is at 5.3% in the month of July compared to 5.2% in the month of June this year. That's one data. Then came the retail sales growth data. The retail sales growth, slowest pace since December 2022. And also investments in property sector down 8.5%. Property sector has been in pain in China for the last 18 months, ever since the Evergrande controversy. The collapse of Evergrande happened in China and continues to be a huge pain point, to the point where lesser property is being constructed. Total constructions are down. The price of home sales, the new home prices are down as well. So the property sector is in a world of pain of its own. And bear in mind, China prides itself in how much it can construct and how many houses it sells. And in fact, that counts that as a gross domestic product, the number of houses it makes, not the number of houses it sells. Even the amount of making is down now, and that's the reason why it doesn't want to show these facts. It doesn't want to show these numbers. It doesn't want to show this data. It wants to hide this data. So again, new home prices falling, retail sale, industrial output again down of below estimates, down from last month. It's going down by the month in China, to the point where when it came to data for July, China just put a full stop to it and said that one data we're not going to get out from now on is the unemployment data, especially the youth unemployment data, the age of 16 to 24. The youth unemployment data is over 20% right now. It is at an all-time high, and it was expected to go up even further for the month of July, and that's where they've stopped. They said that we're not going to publish these numbers anymore. Unlike that, there are other numbers that they don't want to publish. Property numbers that they don't want to publish.
They don't publish already.
They don't want to. They officially want to hide at a time when Xi Jinping comes out and in a speech tells the people of China to be more patient, because
optimistic.
They call it a quote-unquote the time of economic rejuvenation. That's what Xi Jinping is calling it, and he's asked people to be patient. So which clearly means that it's difficult to even hide the fact that the economy is not doing well for itself. People know it, the government knows it, Xi Jinping knows it, and it's coming out in plain sight, despite the fact that they want to hide so much of their data.
Okay. Before I go to Karan, I also want to quickly come to you, Kranti, before I let you go. Perhaps the last question to you at this point in time. All right, we don't have Kranti, but Karan, essentially alluding to what I was saying earlier, and that is there was a point where China's loss was India's gain. But I think we've gone beyond that point, because we're talking about a largely export-driven economy, an economy that is also responsible for a lot of consumption in the global market. Essentially, China not doing well means there will be a crisis of balance of imports and exports. It's already affecting markets. It's already affecting sentiments all across the world. Not long before this becomes bigger and bigger, what can Chinese government do at this point in time? There is an absence of enough fiscal stimulus, as many economists are pointing out. But what, according to you, can Chinese government do at this point, and how bad are things looking?
Well, first of all, thank you very much, Shweta, for having me. First, I'll talk about the problems that we are facing right now when it comes to China. The real growth numbers, Shweta, might come below 5% this year. So this is a big deal for an economy that is used to growing at 8 to 9%. Now, mind you, Chinese economy was expected to be the world's largest economy before 2030. Now, with these kind of numbers, it looks highly unlikely that that would happen. Real estate sector that you were discussing earlier, it contributes around 30% of the Chinese economy, is under a significant threat due to mortgage boycotts and debt defaults. So demand is simply not matching the supply side's optimism at this time. Investment in the sector has declined by over 7% as we speak. Exports, which are the backbone of the economy, have been floundering and have declined by over 20% to the US alone. At the same time, foreign direct investment is declining despite big ticket announcements from German car makers. The only saving grace for China are the retail numbers, but with an average growth of around 3 to 4%, consumer demand, I think, cannot alone rescue the economy, which inherently is not consumption driven. It is not domestic demand driven economy. So deflating, as the Chinese central bank is cutting interest rates despite a healthy looking overall unemployment number of just 5.3%. This means that these numbers are much higher than data suggests. So to my mind, what the Chinese government can do at this point in time is to first try to pacify the Americans and the West, because at the end of the day, Chinese exports are driven by demand in Europe and America. If they continue to talk hawkishly and talk about invading Taiwan, the problem will be even more deeper, and it will be very difficult for Chinese government to get over it.
All right, and let's go through some of these numbers one by one. And I think some of these numbers that are, in a sense, staggering against China at this point in time. Number one, to begin with, is unemployment rate, which is difficult to hide, also very difficult to contain. When you have a lot of people on streets, and we saw what happened when there was zero COVID restriction, zero COVID policy, which essentially meant a lot of people were disenchanted, they were unhappy, they took to streets, and the government had to come out and remove some of those restrictions, open up its economy eventually. We see a repeat of that, in a sense, with Xi Jinping coming out. It's very unlikely for a communist country or communist government to come out on record and try and allay some of those fears. So I think unemployment there remains a major problem. And then apart from that, economically speaking, from consumption to deflation to industrial output, which is at an all-time low, lot of factors that are not working for Chinese government, Krishna.
At this stage, it is difficult for the Chinese government to maintain its growth rate, which is their estimated target, which is 5%.
5%.
And literally, from the moment they mentioned that as their estimated target, literally everybody across the world, rating agencies, and everybody just came out and said, Morgan Stanley, just about everybody came out and said that they're going to find it difficult to come up with that 5% number because quarter on quarter they're not able to meet their targets. So that annual target of 5% too is looking difficult. And here is the problem. You take it further. If they fall down to the growth rates, GDP growth rates of, say, the US and UK, which is around 2 to 3%, that's when the real problem really begins. The fear for the world is that when China's growth rate halves from 5% to 2 to 3%, that's when the alarm bells will go off completely. For now, we look like it's a slow stumble towards that eventual 2 to 3% growth rate for China because of what you're seeing across on the big macroeconomic indicators for China's growth. One is the unemployment rate. Overall unemployment rate is just steadily climbing up. Last month 5.2%, this month 5.3%. Unemployment rate for the youth specifically, speaking for the 16 to 24 age group was at an all-time high already last month in June, and this month they've officially stopped publishing those numbers. That's a key indicator of what's going on in the economy. And with the fact that the amount of activity literally that's going on in the economy, construction activity is down. Home prices, new home prices are down. People don't want to buy new homes. People, not enough homes are being constructed in the first place. This is not the kind of situation that China has witnessed in over a decade. Ever since its a hectic pace of growth began. So these and economists across the world are already saying that expect more of this. This should not be a surprise. There will be stumbles like this, and many more stumbles is what is expected from China. The fear is for the world economy, for the global economy, is of all these stumbles eventually result in China's overall GDP growth rate number being brought down below that 3% mark. I think that's what we're to watch out for going forward.
And China, which is a significant makes a significant contribution to the global GDP growth rate. Karan, the fear, of course, is that this will have an impact on markets, this will have an impact on exports, and in turn affect economies all across the world. How much, and what should the government at this point in time do apart from the 10-pronged strategy that the communist government did come out with, saying that this is what we're going to do to allay these concerns, we're going to make sure that we fire up growth engines, but that hasn't really happened so far. How concerned are you that the impact on global economies across the world, US to India, or India specifically rather, will be long term, and what can India do to sort of protect itself at this point in time?
Well, Shweta, there's a little that the world can do apart from just praying that China does not just disintegrate. That is a strong statement, but I mean, if you look at what communism is, then communism is built on fair treatment of the labor class. Anything that breeds resentment in the labor class, as we are seeing at this point in time, is a recipe of disaster. The Chinese leadership knows that, and the only way they can suppress the resentment is through an appeal to morality and suffering for the greater good. This is generally not successful, as we have seen during the protests in Eastern industrial SEZs in China due to COVID-related restrictions, as Krishna was alluding to earlier. Once public resentment goes out of hand is when it comes undone, and that starts with lack of employment and consumption restrictions. We have seen similar events unfold in East Germany and Soviet Union before the fall of the Iron Curtain. So I am quite, I'm just waiting how events will unfold in the near future, because China single-handedly has reduced the global inflation significantly, given the fact that China is the factory of the world. If China is not able to manage its internal affairs at this point in time, the world is actually looking at a very high inflation scenario, and supply chains will not have enough time to reorient themselves, and the fact that we still have very few pockets that can actually challenge or match Chinese capacity. So it's going to be a very difficult phase if China is not able to maintain its domestic politics, and there's a great deal of resentment in China in the near future. That's going to be a big problem for the world.
Hi Karan, so I have a question for you. China obviously fell into deflation last week. So how big of a concern is that? Because from what I understand, deflation is a problem if it is only persistent and it occurs at a time when companies are desperate to sell to consumers who are not willing to buy. But this does not seem to be the case that describes China's economy or the price movements, because after all, you are expecting a 4 to 4.5% economic growth, right? So what I'm asking is deflation a temporary stage for China, or do you expect it to prolong?
The problem here is, Suyash, that Chinese economy is an export-driven economy. Now, given the fact that as I was mentioning, Chinese exports to the US alone have declined by over 20%. Now, when you compare the overall decline to US exports, then that's around 7 to 8%. So the Chinese exports are actually declining. And if you look at the aggregate demand equation, then the primary driver of the Chinese economy were exports. Now that exports are declining, and given the fact that, as I was mentioning earlier, that China-US relations are not at their best, and given the Taiwan threat, the Americans are trying to convince their corporates to reorient the supply chains away from China. So that is a big threat for China. Again, if you look at the aggregate demand equation, then the only variable that is actually in favor of China is the retail sales. But even with that is growing at 3 to 4%. So that is not significant enough to sustain the Chinese economy, which is worth almost $19 trillion. And China, again, is not a domestic demand-driven economy. So a 4 to 5% growth rate for an economy that is not yet rich, and that is still relatively unorganized as compared to peers in the West or the G7. A 4 to 5% growth rate is not sustainable for China. China has to grow at least 6 to 7% to actually, achieve its potential. Because the only way communism works is that the economic activity has to continue unabated.
Right. I hope it continues to work that way. For China's downfall is not going to augur well for anybody at this point in time. China contributes, remember, 22% of the global GDP, and the fact that it is a major destination for supply chains of all types of companies who have interest in China means if China doesn't do well, it's going to have an impact on global trade partnerships, have impact on every major economy, developing economy and developed economies around the world. An impact in the markets can already be seen. China feeling the pangs means markets around the world not doing too well at this point. Karan, thanks very much for taking time out, for joining us this afternoon.